With inflation across Europe at sort of a 4-year low, do you view Europe entering into a deflationary period to be much of a risk? And if so, how do you seek to mitigate those risks across your portfolios?
Levered real estate needs inflation. Because if you're long and levered, the worst thing you can have is price deflation. It makes you're always at that risk. I think there's not a lot you can do to mitigate that risk because it's an economic risk. You can have floating rate financing. That's one way of mitigating that risk. So that's something you can build into the way you think about your financial hedging strategy. But do we see it as a risk right now? I think the example that has been set by Japan over the course of the last 15 years and most recently tells you a lot about how central bankers view the risk of entrenched deflation. And the ECB's actions that we've talked about today, highlight that the ECB is very sensitive to that. But I also think you have to kind of break Europe up a little bit. Germany is not about to tipple into deflation, given where real interest rates are. So I think the degree to which you look at Europe, you can kind of pass it by things that are going to experience some deflation and things that aren't. And the reality is, if you do get labour cost deflation in economies like Ireland, the economy comes roaring back. Spain, part of Spain's recovery story is about deflating the cost of labour. So you need some of it. It is a risk, but central banks are very cognizant and focused on not allowing it to become an entrenched part of the underlying economy. So I don't think it's one that we worry about, but yeah, we float all of our financing to make sure that we don't get caught with out-of-the-money swap contracts on that.